Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Vidler and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello everyone, Grace Ormsby here, back with a brand new episode of the Smart Property Investment Show. Earlier in this year, before all, it's kind of weird to think back to February 2021 as being before the latest lockdown. It's funny now looking back, we've sort of come back into a period of normality after extended lockdowns across much of the eastern seaboard, continuing debates about what that would mean for international migration, people returning to Australia, tourism and the like. It feels like we've been having some of the same conversations, but at the same time, so much has changed. And that's why I really wanted to bring back, I've just told him before this episode actually started, but the person who is now holding the number one spot on the SPI show ranking for all of 2021, Dr. Andrew Wilson, welcome to the show.
Well, thank you, Grace. And my head is really swelling now. You've sort of told me that. So I'll try and have to sort of match that at least with the, I guess this is the end of the year show to some degree. And I look forward to our conversation.
It is kind of bookending 2021, but it has been a very, very weird year. I think that's, a fair enough statement to be making at this point in time. Andrew, can you just, looking back on 2021 for you, and I want to bring up that February episode to anyone who hasn't listened, The Mathematics of Property Investing, go check it out, well worth a listen. You predicted in that episode that Australian property prices across the board would be rising by 10% over 2021. It's safe to say that we've gone above and beyond that expectation, but it's also been driven by things that we weren't expecting.
Yes, look, to some degree, Grace. I mean, my predictions were based on the fact that we've had a really interrupted housing market cycle over the last 4 years. We can go back to 2000, well, even further back than that, but we can go back to, I guess, 2018 when we had that intervention from APRA that created a credit squeeze for investors. These were sort of artificial actions that pushed down the normal flow of demand in our housing markets. So these interruptions, once they sort of become a thing of the past, we see the pent-up demand being released. So it's just an interruption. It's like a dam being put over the river. The river banks up, and then when we take the dam down, it floods out into the wherever it was going to go originally. And that's what we've seen really over the last couple of years in our housing markets, has been that interrupted release of pent-up demand. So really we're just getting back to where we should have been if we hadn't have had the interruptions of 2018, 19, last year with COVID interruptions, and again this year. But I do think we're now getting to the end generally of that, I guess, pent-up demand flow that has been pushing prices up as strongly as they've risen virtually across the board this year. And that's because eventually higher prices do create affordability barriers. You just can't keep going to the bank and saying, look, I need another $100,000 to buy this property because prices are rising so strong. And they say, well, okay, that's fine. Are you earning any more? Well, the answer to that is still no, I'm not really earning any more. And then you ask the bank, can you give me a lower interest rate? And they'll say, hang on, gee whiz, look at how low their interest rates are now. So really it does start pushing buyers out of the market. And the other point is, as I said, a lot of that pent-up demand has now been satisfied. Of course, buyers don't buy a house every week. The usual period between home purchases is around about 6 years on average. So people have now, got to buy the properties they were interrupted from buying over the last few years and are enjoying that. So buyer activity is reducing. Higher prices are pushing buyers out of the market, particularly first home buyers, of course, because they can't take advantage of a trade-in because they don't have a trade-in that owner-occupiers do. So that's just a general stabilisation of the market. And it's something that we should embrace and welcome, because it's not about higher interest rates this time, pushing prices down and easing market activity. It's just about the sort of normal stabilisation that higher prices create less demand because affordability falls. So this is why the outlook is one for a moderate reduction in housing market activity, notwithstanding the likelihood of higher interest rates. And that still is a very remote possibility.
And we're going to get to that a bit later, some of the claims that have been flying around. But before we do, there's probably a lot of people listening along to this episode that are investors in the market or looking to sort of purchase that first investment property.
Yes.
And house prices continuing to rise is a good thing for them. But what should their sentiment actually be at the moment? You know, how positive can investors who are looking at the market, how okay is it for them to be positive right now?
Well, it's a very positive environment, Grace. Not only, of course, investors taken advantage of a surge in prices this year, and investors love those capital gains, don't we all? But also we're seeing at the other end that usually yields start to fall as prices rise, of course, but we're seeing a surge in rents, particularly for houses everywhere at the moment. And that's because we have a shortage of rental properties. A couple of factors there. Of course, the credit squeeze that was placed by APRA on investors has acted to reduce the supply of investment properties into our rental markets. And of course, that actually also acted to reduce dwelling construction, particularly units, which were favoured by investors. So we've had a reduction of demand and a reduction of supply. So all that means is upward pressure on rents. And rents in most capital cities for houses are now rising by over 10% per year. So again, this means that yields are holding even though prices are very strong. Now, there's no prospect of an easing in high rents going forward now. So those yields will stay quite positive. And of course, prices aren't going to fall. They're going to continue to rise, in my opinion, because the only factor, as we've sort of alluded to already, for lower prices is higher official interest rates. So the prospects are still very good for investors out there. And look, we shouldn't be surprised that we've seen a real surge in investor activity over the past 12 months. In fact, investor lending has doubled over the past 12 months and still rising. Now, even though owner-occupier lending is starting to ease and first-home buyer lending is starting to ease because of those affordability issues and, of course, the constraints of the recent constraints of lockdown, we're still seeing investor activity on the rise. And I think when we are talking about investors, Grace, we need to look at the market share that investors have at the moment. Now, if we look at the market share of total residential lending of investors, for investors, we can see it's still below the long-term average. So it's still under 30%, and 33% is the long-term average of investor activity in the market. So there's still plenty of upside there if we look at the normal position of the market for investors. And I expect investor activity to continue to rise. And look, part of the reason is that banks have now, certainly over the last year, had a more relaxed attitude towards lending to investors, because returns have been high, and also, of course, because the rental market is very tight. Even the unit rental market in those areas which did suffer from lockdown, that is the inner suburban unit markets in Sydney and CBD in Melbourne, they're starting now to pick up tenants again, and vacancy rates are tightening in those markets. And once we open our borders up, and gee whiz, haven't we got our fingers crossed that happens pretty soon, because we know it's just a few little dark clouds around that one. But if we do see migration, open borders and international migration resume, particularly from students, that will really soak up those inner city units that have been struggling to find tenants over the last year or two. And part of that story, of course, is that once we open our interstate borders, we'll see the resumption of business travel and tourist travel, which will then take a lot of the Airbnb tourist accommodation out of the permanent market, which has added to supply over the last year because the Airbnb product has been pushing into the permanent market. So the upside is clearly there for rental growth in just about across the board. We have a shortage of rental properties. That's not going to end anytime soon. And we still have the prospect of quite solid prices growth in most capital cities next year.
Some very affirmative words there and very exciting times ahead. So I just want to point out at this point in time to all of our first time and new property investors who may be tuning in, we do have our first ever buyer's guide going out on the Smart Property Investment website, all about getting started on your property investing journey. And it is powered by our partner, Bluestone. We've put a lot of time and effort into creating this toolkit that you'll need to get underway, helping you fast track your finance and getting started on your first purchase with Australia's leading non-bank lender. Jump to the homepage of smartpropertyinvestment.com.au, register your details and learn how to buy property coming into 2022. We're going to take a quick break there, Andrew, but we'll be back soon with more of what's going on, what to expect for investors in the year ahead.
Thank you, Grace.
Welcome back to this very special episode of the Smart Property Investment Show. I'm joined by Dr. Andrew Wilson, consultant economist for Bluestone. Andrew, just before the break, we were talking about, the great conditions that we're sort of starting to find ourselves in, especially for investors, anyone, even owner-occupiers, it's still a great time. There's no real signs on the horizon for prices to actually drop. No. And that is something that we're still going to get to. But before we do, I just want to talk about some of the recent things that we have seen that have been flagged and have been seen as potential issues. And the first one there is just APRA coming in and deciding to impose a little bit of a higher service rate buffer. In your perspective, from your opinion, how much has this actually affected the market? Because it only came in a month ago now.
Well, I think it's, firstly, it's questionable about, introducing the interest rate buffer that APRA have. It was previously 2.75 and they've moved it up to 3% now. That means that basically you need to be covered for a 3% increase in the interest rate now in your mortgage rate. I really think that we're so far behind that happening that it's really very fanciful. But nonetheless, that's the role of APRA. They are there to risk manage the banking sector. We need to have a risk-managed banking sector. It's very important, but it's also important that you don't throw out the baby with the bathwater in these types of policy settings. I am a critic of the previous policy settings from APRA. I think they have resulted in particularly a tightening of our rental market with reduced investor activity. But of course, it's not APRA's role to, be managing the economy or the housing market. They're about risk managing the banks. But I really think the big question here is whether banks have too much market power. And this is what we see when we do have these, issues that arise from, the banking sector, either through its corporate risk management or just through its corporate profit agenda, affecting consumers to a large degree, because we only have 4 big banks. They manage most of the lending, the home lending in this country. And we can be a hostage to that very strong market power of the banks through these policy changes. And I think we've seen a little bit of that this year as well, when we've seen a very strong shift in the middle of this year to refinancing. And I think a lot of that was because of predictions that were coming from the banks of higher interest rates, and that motivated a lot of consumers to refinance. Now, we're back in that mode again with predictions of high interest rates sooner rather than later coming from the banks. And I'm just asking the question, is this part of the motivation for these predictions being that, it would encourage some to refinance? But at the end of the day, as I said, I don't challenge the right of APRA to be risk managing the banking sector. But at the moment, it can have consequences broadly in the housing market. We've clearly seen that over recent years, and the economy. But I don't think the current actions by APRA have affected materially or significantly housing market activity. And I think the portents are pretty good that we won't see any further direct interference in lending from APRA, because we're certainly seeing an easing in housing market activity, which was eminently predictable, particularly in Sydney and Melbourne, which have had prices going through the roof on and off over the last 12 to 18 months. So I think that we can perhaps relax a little bit, that there won't be any more interferences from APRA, although current news is that they are again looking at the actual structure of the banking system in terms of of risk management, which, again, may constrain lending down the track. But at least we're moving through the very strong lending cycle now that we've had over the last couple of years. So I don't expect any further action, Grace, given that housing markets are easing. And I think that any action would be at the margin anyway and won't impact our housing markets.
Yeah, a bit of a watch this space kind of area, but also good to know that there's not really much that we should be expecting in the foreseeable future, which brings me to the next point, which is around that supply and demand issue that we touched on earlier in the episode as well. But obviously we've seen Melbourne and Sydney's auction markets, a lot of properties now going on the market,
Yes.
A lot of auctions taking place over the past weekend.
Yes.
Not as many actually successful though.
No.
Why is this? Talk us through that.
Well, law of supply and demand always gets you. That's the one part of economics we can't argue about. And last weekend, we had remarkable numbers of auctions really across the board, but particularly in Sydney and Melbourne. Sydney broke the all-time record for the number of auctions conducted on a Saturday. It's broken the record for the number of auctions ever conducted in a month. So, of course, and despite that, clearance rates still held above 75% towards 80%. So it's still a seller's market in Sydney. It's just that a flood of listings is really impacting or testing buyer depth. And I still think it reflects that seller's market environment that Sydney has. And even though we had a record number of listings over November in Sydney, the median auction price still increased for houses, increased by 1.5%. So we've had record sales, we've had a record turnover, record listings, and we're still seeing prices increase. So that's still a very strong market, the Sydney market, Grace. And it's just remarkable that they're able to absorb, 78% of auctions given all those listings. Now, Melbourne very similarly had over 1,500 auctions on the weekend. Now, that was a near record for a Saturday. Its clearance rate, however, fell below 70%. Its Melbourne market has just started easing, perhaps a little questionably over the last month. There was an expectation following the end of lockdowns in Melbourne that pent-up demand would, roll back into the market. And as happened a year ago, it would be a very strong end to the year for Melbourne. But Melbourne's actually gone a little bit, or has acted a little weaker than expectations. And I don't think it's just that supply factor that's pushed the Melbourne market down. Perhaps it has reached that point where affordability is pushing buyers out of the market. But the one issue that we have with Melbourne still, and it has been part of the Melbourne housing market dynamic over the last year or so, is migration. And there's no doubt that there's been an exodus out of Melbourne from those, I guess, concerned about the COVID environment, the lockdown environment in Melbourne, heading particularly into southeast Queensland, which is always a favoured destination for Melburnians. But this time that's accelerated. And I think that's part of the reason why we're seeing a booming southeast Queensland housing market at the moment is that remarkable migration, particularly out of Melbourne. And perhaps that's impacting housing markets at the moment. But look, any clearance rate above 65% is still a seller's market. Lots of, near record numbers of listings in Melbourne have certainly acted to test buyer depth, but it is a little bit lower than expectations. Now, the expectations given the end of lockdown. But when we look at the smaller markets in Brisbane, Adelaide and Canberra, Grace, they're just still roaring along, red hot markets, big numbers of properties, record numbers of properties coming into those markets. Clearance rates have fallen, and again, a response to high listing numbers, testing buyer depth, but still very much those three markets are sellers markets, and prices are still rising there. In fact, the Brisbane market auction market has had an extraordinary year this year. At some stages there, we had Brisbane recording the highest clearance rates of any of the capital city markets. And it was a year ago, typically the Brisbane auction clearance rate was set around 50% because it had a different auction culture in Brisbane. It was more an entree to the main dish, the actual auction, and look, they tend to be passed in and then sold straight afterwards. But now we've seen clearance rates consistently in the mid-80s in Brisbane, and of course prices are growing very strongly. And I think that's what's happened. The Brisbane market has embraced auction activity, the auction culture, because if you've got strong competition for property, usually the best way to go is an auction so you can get the top price. That's the theory. I think the Brisbane market has embraced that. So, look, the recent data is still strong. It's certainly lower than where it was. Sydney's in the mid to high 70s compared to the low to mid 80s a month ago. And, of course, the Sydney market was clearing at around 90% auction clearance rates back in March, which is just crazy stuff. Never seen that before. But the market's easing. It's stabilising naturally. But part of it is, of course, as you said, Grace, supply, record supply. And that supply isn't just the usual end-of-year surge in listings, which we see every year. It's also catch-up from the lockdowns where sellers were restricted a couple of months ago, now back into the marketplace. But there's still good results there. But perhaps certainly the surprise packet to some degree has been the Melbourne market.
Do you think we're going to see that change even more as borders between states begin to open? Obviously, there's still a lot of talk, and with this new strand of COVID-19 potentially putting a spanner in the works, it might be even longer still. But how much are those arbitrary borders actually affecting the market at this point in time? Well,
that's a very good question, Grace, and that's yet to be revealed. We can look at factors such as, Brisbane's employment growth has gone through the roof over the last 12 months despite COVID. Jobs are growing at the fastest rate of any of the capital cities in Brisbane at the moment, and that might be because of the influx of migrants. We see a shortage of rental properties. Prices are going through the roof. There's plenty of demand, plenty of anecdotal evidence of a surge in migration out of southern states, particularly Victoria. And the latest data is, unfortunately, the March quarter data, so from the ABS. So we await the latest data to come out on population shifts, but I think it will continue to show that. The real question is, sort of as you've alluded to, is will that continue now that borders it's a lot easier to get into Queensland, but will that mean that, the fact is we're less worried about COVID and lockdowns in the southern states, in Melbourne in particular, so those plans to, I guess, move out of Melbourne and head towards what are perceived to be safer areas, even though it might not be logical, such as Queensland, it remains to be seen whether that is continuing. But maybe the sign of, fewer sales now in Melbourne isn't just a factor of high listing numbers, but also reflects that migration continuing. But it will be interesting to see that when the latest data does come out, Grace.
What are we expecting then from 2022 on a more holistic level? There's still so many positive signs, but there is so many unknowns at this point in time, as we've just mentioned, with all the migration, international and internal. How do you go about making projections and forecasts when you don't really know what's going to happen?
Well, actually, Grace, I think notwithstanding COVID, we actually know a lot more and can be a lot more predictive of next year than we have for quite a while. Firstly, we know that affordability is starting to stabilise markets, that we've satisfied a lot of pent-up demand. So the market is, I guess, looking at its natural stabilising impact. So we know that prices will continue to ease rather than fall. The other point is we are in a revival in our economy. We will see our economy reviving after the recent lockdown. So that's a positive for actual capacity to purchase a home and also confidence. I don't want to overstate, we've had a little bit of overstating about the boom that's going to happen as a response to the end of lockdown. We've still got some hard yards to do, Grace, in terms of recovering our economy. But that will be a positive for our housing markets. We know that going forward. The policies have changed, even though they will be tested maybe with this latest variety. But the policies have changed now where we won't have to, it looks like, worry about lockdowns because it's the vaccination policy now that's guiding our control of COVID rather than lockdown. So it's accepting of the virus rather than trying to eliminate it. So that's a positive. So we don't have to worry about those interruptions, perhaps. Recovering economy, and we're seeing borders open, as part of that. So we will start to see more of a natural flow between states, but most importantly, we will see that flow, all things being equal. And we're really, I guess, given latest news, talking highly speculative perhaps, but let's sort of put that to one side. But once we get international borders opening, that will really help our housing markets particularly. Now, the government's announced that they're going to allow 200,000 visa holders back into Australia almost immediately. And of course, that will have an impact not only on our labour market, perhaps on the negative side in terms of putting downward pressure on jobs, incomes growth, because there'll be more competition for jobs or more supply of jobs from international migrants. But also, of course, they need to live somewhere, and that'll be a surge of demand into our housing markets. And last but not least, the one thing that we always look to in terms of our housing market cycle are interest rates. And I firmly believe there's absolutely no prospect of higher interest rates next year. And I believe there's no prospect of higher interest rates in 2023 as well. And expect I guess those that are predicting higher interest rates next year to be changing their mind pretty quick. And I guess, unfortunately, the arising of another COVID variety will also impact any prospect of higher interest rates next year. We are so far behind the requirements in terms of sustained inflation and sustained incomes growth that would reactivate the Reserve Bank into raising interest rates. It's not funny. It's, coming on to 11 years since we had our last interest rate increase. And given current economic circumstances, we're as far away from an interest rate increase from the Reserve Bank as we possibly could be, particularly given that we still have this spectre of COVID hanging over our heads. But the underlying fundamentals for higher interest rates just aren't there, not even close. And those that have been predicting them for next year, towards the end of next year, we would already have to be seeing a boom certainly in incomes growth, but coming from a booming jobs market, which is just in recovery phase. And the unemployment rate jumped up over October. So there's just no sign, really. There's no rational argument in favour of higher interest rates next year, and I believe in 2023. And Grace, as we all know, it's higher interest rates that create lower house prices. But history tells us that it has to be higher interest rates for a period of time before it actually pushes down interest rates. And let's pushes down house prices. And I'm going to finish this, I guess this is a bit about forecasting, with some data, some historical data. And
we love to see it. We love data.
Well, so do I. But you can't always rely on data. But this time I think we can. Because if we look at the long-term statistical models for house price changes over a year, and with the ABS data, we can go back to 1987, which is a fair way away, and look at since 1987, we've only had 3 years where house prices have fallen nationally, their home prices have fallen nationally over the year, and that is from December quarter to December quarter. And that was 2008, 2011, and 2018. In 2008, house prices fell by, hang on to your hat, 4%. In 2011, hang on to your hat, they fell by 4.1%. And we had a terrible year in 2018 because house prices fell by, terrible, 5.1%. Now, let's remember that house prices are going to rise by 20% this year. In Sydney alone, they're up by 30% this year. So all those periods of house price declines were characterised, particularly 2008 and 2011, were characterised by a reasonably long-term period of increased interest rates from the Reserve Bank. So let's have the final say on this from the Reserve Bank, and that is, again, they reiterated in their recent meeting on Melbourne Cup Day that they believe quite firmly that interest rates will not increase until 2024. Read my lips, interest rates will not increase till 2024, given that the Reserve Bank believes it will not be until then that there's a sustained matching of the inflation targets, and they're concerned that the income targets won't meet that, even if the inflation targets are thereabouts. And look, I'm not in the business of forecasting, it's tea leaf reading. I can generally give a good result with a 12-month forecast. But once you move past 12 months, it's really dartboard stuff. So given current data, that's where I think the markets are heading at the moment.
So just to clarify, you're saying that we probably should take predictions that house prices will drop by 10% in 2023 with a grain of salt?
Never happened before. And certainly we've never had house prices falling without a significant period of interest rate increases from the Reserve Bank. I mean, how much, if we were having a debate, surely I've won the debate. But just with those few lines, I'm just relying on what the Reserve Bank says. And at the end of the day, they're the ones that are in charge of interest rates. And we know that interest rates affect house prices. But it's almost an urban myth that, we've had these house price crashes in Australia, but we never had them. It's like even during the recession of 1991, house prices increased. And that's because interest rates fell. It's always about higher interest rates. But interest rates, to push house prices down, you always have to come through a sustained period of higher interest rates. It takes some time for that to impact our housing markets. And as I said before, the drivers are still positive. We're improving our economy and we've got all this demand coming in. And the other point that these forecasters seem to forget is that if we had the sort of prices or incomes boom that we haven't seen for a decade, which was during the last mining boom, if we get that 3 to 4% annualised increase in incomes, well, why is that a problem for mortgage holders? Because they've got all this extra income to cover the higher interest rates, seriously. And they've all had a 3% buffer anyway, thanks to APRA to cover it, And you really think they're going to rise 3%, next year? Oh, please, give me a break. You make it a bit harder for me, Grace.
You presented some great arguments here, and I have every cause to believe you on this. It does make me think, though, how much are these forecasts and these predictions that are coming out, while they may not be true, are they actually having an impact on sentiment? Are we seeing that play out in the market?
Well, I think this is the real issue, Grace, and, I can sort of be a little jovial about it all, but the real issue, I think, is that, look, the forecasters will, a lot of forecasters will come up with another forecast in 3 months' time. And we saw that in the middle of the year where there was a raft of forecasts that house prices were going to fall, in 2022, 23, interest rates were going to rise. We saw a surge of refinancing occur on the back of that, with consumers concerned that, that they might get caught with higher interest rates. So they decided to, have a bit of a flutter and gamble on higher interest rates. Now, there's a cost to refinancing. And since then, those that were forecasting prior to the recent lockdowns were forecasting higher interest rates changed their mind. And they said, oh, well, lockdowns came, so we've changed our mind. So the point is, a lot of these forecasts, and we'll just look at some of the forecasts that were made a year ago, Grace, and just see, how they stand with the ones that are being made now. But the point is that a lot of these forecasts are revised in the shorter term. And the forecasters, when they are held up to, I guess, making, forecasts not being accurate, just say, well, that's not our latest forecast. You have a look at our latest forecast. So the whole point is that it's a bit of a shell game in that sense that, forecasts, what good are they if they change every 3 months? But it is important for consumers to understand that these forecasts do change and that they need to have a much more robust insight into the dynamics of interest rates and housing markets before they make important investment decisions. I think that's critical because they're the real losers out of all this. It might be clickbait for the forecasters and, they might get plenty of headlines. But at the end of the day, if you make a significant financial decision based on a forecast that will change in 3 months, and I think those forecasters, perhaps with the issue of COVID again re-emerging, will say, well, COVID happened, we'll change our forecast. But as the data comes out, and I think it will clearly show we won't have the surge in activity that's been predicted to drive higher interest rates, I think the forecast will change and it'll just simply be a matter of, well, the data wasn't as strong as we thought it would be. And that's okay for that. But at the end of the day, it's not good if you've refinanced or purchased or not purchased a property based on, predictions that, that have been not accurate.
Some very interesting points there. I want to come back and ask you what those data points are again. We've talked about it previously on Smart Property Investment Show, but just to reiterate from you again, stick around. We'll be back soon.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back to this episode of the Smart Property Investment Show, where I'm joined by Dr. Andrew Wilson, consultant economist for Bluestone. Andrew, just before the break, you did give us some great insight into some of those forecasts that are happening from the big four banks. That's probably been a bit of a theme throughout. But by the sounds of it, and I tend to agree with you, they're not the indicators that we should actually be basing investment decisions on. Where should people be looking instead to get their data?
Well, firstly, of course, interest rates that we've discussed at length today, Grace, are very important in terms of, we know that, in terms of what happens in our housing markets. Lower interest rates improve affordability, means you can pay more with a given income for a home. So prices rise. If interest rates rise, it means you can't pay as much with a given income, so it reduces demand. So the interest rate equation is quite simply, as the Reserve Bank explains, about inflation and incomes growth. We need to have inflation and incomes growth over a sustained period rising by between 2 and 3%, closer to 3%, before the Reserve Bank would think of increasing interest rates. Now, we're a long, long way from that. The latest inflation data was higher than expected, but that was because of basically one-off factors, very high home or house building costs as a result of the surge in construction through the home builder allowance. And of course, we've had a surge in fuel costs. The price of petrol's quite high. It's starting to fall now. And that's because supply hasn't kept up with the re-emergence of post-lockdown demand globally, but it will catch up because there is no shortage of oil, underlying shortage of oil. So these are one-off factors which will gradually ease inflation. So we need to watch inflation firstly, and then incomes growth. Now, incomes growth is, even though it bounced back over the September quarter, which is the latest data, is still at 2.1%, well below where it was in 2010-11 when we last had an interest rate increase, when it was pushing towards 4%. So what you've got to do is to see a sustained period, that is 2 or 3 quarters, and an upward trend in incomes growth. And the wage index from the ABS is what you look out for there. And also the CPI, the inflation data, similarly, 2 or 3 quarters moving certainly above 2%, but between 2.5% and 3%. They're the conditions which will activate the Reserve Bank. Unfortunately, it's a bit backward looking, that data. So that's why you can get plenty of speculation, because the data doesn't come out for 3 months. So you can say, oh, it might be this or it might be that, and that fuels those predictions. But we are coming out of an extraordinary, unique circumstance with lockdowns, not just locally but globally. So we need to understand there will be some adjustments to inflation and incomes growth going forward. So forget the forecasters, just look out for that data as it comes through. But clearly listen to the Reserve Bank, and they release their minutes every month. They'll tell you what's going on. But notwithstanding interest rate policy, we need to understand that markets don't always move in tandem. They usually move in the same direction, up or down, according to interest rate changes, but markets can move at different rates according to local supply and demand factors. Now, at the moment, we're certainly seeing the Sydney and Melbourne markets easing. Prices growth is still strong, but it's nowhere near where it was in the middle of the year. However, conversely, prices growth in Brisbane and Adelaide is still rising. And the Brisbane market is now rising at a faster rate than any of the other capital city markets. In fact, my latest data shows me that the Brisbane market is likely to increase house prices in Brisbane by around 3% over November, which is a very, very strong result. And its trend has clearly been upwards over the last couple of months. Adelaide also has been strengthening as a market. So a little bit too paced, certainly still on the positive side of the equation, but this is what happens once those stabilisers set in. And the whole point is, Grace, that the Sydney and Melbourne markets are the ones that have been growing the fastest. Now they're the ones that are, starting to run out of puff, whereas there's still plenty of upside in terms of affordability in the Adelaide and Brisbane markets because their prices are well below the prices in Sydney and Melbourne, and yet their local incomes are around about the same. So it's sort of predictable, but this is all part of the cycle, evolving, from without the hammer of interest rates as usual, changing price dynamics.
On that predictability piece, Brisbane was one of the markets that you flagged back in February as being a big winner for investors this year, and that's clearly come to fruition.
Yes.
How much further do you think that's actually got? Because we've talked previously on the Smart Property Investment Show about the fact that, they're hosting the Olympics in just over a decade. There's still a lot in the pipeline for it. It's going to be a growing city.
Yep.
How long will that run last for, do you think?
Well, I think Brisbane's will be, with perhaps Canberra and Adelaide, as we've discussed, the number one performers next year. I think they'll push up towards 10% prices growth again. I think that's a reasonable assumption based on the fact that they still have affordability upside because their prices are still well below Sydney and Melbourne, their median prices. In terms of the Brisbane market, it has, I think clearly, as we discussed, Grace, migration is a very important factor into Brisbane, southeast Queensland, from southerners, trying to, I guess we call them the COVID refugees, and there's perhaps some way to go on that as well. And, other factors that the Olympics is part of that underlying confidence in the local market. And with Adelaide's been a big performer this year as well and continuing to rise. I think the Adelaide scenario is being based on what's been a remarkable turnaround in the Adelaide economy. The Adelaide economy has been an underperformer for a number of years, but it's turned around quite sharply this year. And I think that turnaround in the economy is helping the Adelaide market push through. But at the end of the day, affordability is important in those two markets because they are highly more affordable than Melbourne and Sydney, who, of course, have gone through these remarkable price growth periods of the last couple of years. So they're still, I guess, catching up with their potential in the market. But those local factors, the economy in Adelaide, migration in Brisbane, are the key drivers, which I think will have them at the top of the pops next year.
Exciting times ahead. Heard it here first on the Smart Property Investment Show. Dr. Andrew Wilson, thank you so much for your time today. I've really appreciated it. I'm sure our listeners have as well. I can't wait to look back on this episode in 6 months or so, hopefully as the number one episode for 2021. We'll try and get those listens up there, but it's, as always, been a pleasure talking to you. And thank you so much for sharing your insight into the market.
Yes, thank you, Grace. Good luck. Yes.
To everyone who's listening along to this episode, if you liked it, please like or review us on whatever platform that you do use to listen in. And if you have any questions for myself or anyone here at the SBI team, reach out at editor@smartpropertyinvestment.com.au. Stay up to date with all the latest smart property investment news on our website and our Facebook, Twitter, and our LinkedIn. Until next time, stay safe and well. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.